Hello and welcome to this session. This is Professor Farhat. In this session, we're going to be looking at the private purpose trust funds, which is part of the fiduciary funds. What are the private purpose trust funds and when are they used? Well, the private purpose trust funds are used for the benefit somebody other than, so notice here, other than the government and its citizen. For example, you could have an endowment investment, which is an investment providing income to be used for scholarship, and those scholarships are specific. For example, they go to the kids of fallen police officers. So it's a specific group that's benefiting from that endowment. Okay. For accounting purposes, we use accrual. We don't use modified accrual. We use full accrual. In some cases, the principal is held intact. What does the principal held intact? It means the original contribution, let's assume it's $1 million, it can never be spent. What's going to be spent from that is the income from that. And that income could be interest, could be dividend. And in some cases, so those are called non-expendable fund. You cannot spend them. And in other cases, both the principal and the income can be spent. This is expendable. It's for specific purposes, but it's expendable. So you could spend both the principal, which is the $1 million, plus the income, whatever that income is. So we have to be careful. Now, this sounds like the permanent fund. We have to differentiate between the private purpose trust fund and the permanent fund. Although when I did the permanent fund, I differentiate between those two, but it's good to go ahead and do it again. Okay, although they may appear similar, they differ from an accounting perspective. For one thing, the permanent fund uses modified accrual basis, which is kind of governmental accounting, while the private purpose trust, what we're doing now, uses full accrual accounting. Okay. Also, the permanent fund are included in the government-wide financial statement. So when we prepare the government-wide financial statement, the permanent fund are included. The private purpose trust fund are not included in the government-wide financial statement. Remember, those are fiduciary funds. Those funds are not government's funds. Those are funds that are held by the government for the benefit of someone else. Therefore, they should not be included in the government-wide financial statement. And I used this slide in the prior lecture when we did the permanent fund. This is also a summary. For example, a trust that's be used to the benefit of the government and its citizenry, such as somebody taking care of the cemetery, funds to establish the support for the library, museum. As long as it's non-expendable, we call it permanent fund. If it's expendable, then it's a special revenue fund. Now, trust is to benefit individuals. Notice individuals here, private organization or other government. Example, scholarship funds intended to benefit families of police or firemen killed on duty. Those are private purpose trust fund. And notice the word private. It means they are used for a specific purpose. Okay. As we said, sometimes the principal can be spent, sometimes the principal cannot be spent in those private purpose trust fund. However, when it comes to the permanent fund, one feature of the permanent fund is the principal is non-expendable. You cannot spend it. Now, how does the private purpose trust fund work? The first thing is we have to get money from somewhere. Once we get this money, we're going to take this money and invest it somewhere. Where can we invest the money? We could invest the money in certificate of deposit, savings account, equity, which is stocks. We could invest the money in mutual funds. We could invest the money in bonds, all sorts of that instrument. But we have to be aware that once we make an investment, the investment has to be reported at fair value. What does fair value mean? Hopefully, we all know what fair value means. Fair value means if your investment went up in value, you have a gain. If your investment went down in value, you have a loss. Okay, that's what fair value is. It means mark your investments to market. Write them up and write them down. What's going to happen? You're going to have holding gains and losses. Holding means you are holding them. You have not sold the investment yet. We call them in accounting unrealized gain, or we can call them holding gain or holding loss. Holding gain and holding loss, you have to understand they are reported as net increase or decrease in the fair value of the investment. So you report them as a net increase or decrease in the fair value of the investment. Now, unlike business accounting, okay, the financial statements are not permitted to distinguish between realized and unrealized holding gain or losses. Unrealized, also called holding. Okay, what does that mean? It means when you report your financial statements for this fund, Although you might have unrealized gain and unrealized losses, you don't differentiate them between that unrealized and realized. What is realized? Realized is when you actually sell the investment. When you actually sell the investment, you realize the cash. So the gain is realized. Let's assume you bought some shares in Apple. Okay, you bought 100 shares in Apple, and you paid, just for the sake of simplicity, $10,000. Yeah, right. Okay, it doesn't matter for the sake of the example. Now, let's assume at the end of the year, you still have the 10,000 shares and the value went up to 11,000. Now you have a holding gain of 1,000. Holding, or called unrealized. Now, for financial accounting, for business accounting, you have to show this as unrealized gain. For the private purpose trust fund, you show it as realized. So you don't differentiate between realized and unrealized. So when is the gain realized? If you sold the 100 shares and get the 11,000, it becomes realized. But for the private purpose trust, you don't differentiate between realized and unrealized, which is a little bit different than private accounting. Okay? Changes from year-to-year adjustment to fair value, unrealized gain and losses. So you don't have to differentiate between realized and realized. Realized is the completed exchange when you actually sell them. Okay, unrealized is the change from year to year. You don't differentiate between those two. Also, for investments, you have to have certain disclosure, method and assumption used to determine the fair value. Now, I gave you the example for Apple computers. Apple is a publicly traded company, so we all know how much Apple is traded at any point in time. Why? Because it's traded on an organized public exchange. However, sometimes the fund might buy an investment that's not publicly traded. If it's not publicly traded, we need to determine the fair value. Now, how we determine the fair value? We have to disclose this. The methods and assumptions. We might use cash flow assumptions. We might use whatever we use. We might use a specialist. Whatever we use, we have to disclose this method. So the policy for determining which investment will be accounted for at amortized cost. Also, sometimes certain investments will be accounted for at amortized cost. Usually those are bonds that you are planning to hold until they mature. Okay. Also, which is interesting, real estate investments. Also, if you invest in real estate, as far as the private purpose trust is concerned, you also have to report those at fair value. Now, what's interesting in the textbook, they talk about derivative instruments, which is, I don't believe it's that important, especially for government, but I will go over the derivatives instrument very briefly. So what are derivatives instruments? Derivatives instruments are financial contracts whose fair value is derived from the price of an underlying asset or an obligation. So they derive their value from somewhere else. An example could be a government may enter into a derivative contract to protect against increases in natural gas cost. So how does it work? Let's assume the government, they need 1,000 units of natural gas. They know that's how much they need. Today, the price per unit, let's assume it's $5 per unit. Okay, that's today. But they don't need that natural gas until 3 months from now. So 3 months from now, the government don't know how much it's going to be. The unit could be costing you $7 per unit, or it could go down to $3 per unit. So what would the government do? The government can enter into a derivative contract, basically finding someone that will guarantee the price of $5. This way, if they need 1,000 units at $5, so they know they have to come up with $5,000. So this way, they lock in their prices. This is what derivative is. Okay? They are trying to hedge themselves. In this case, the value of the derivative, which is the contract, is derived from the level and volatility of the natural gas prices. Now, if you bought this contract, let's assume the government paid $500 to purchase this contract. So they paid somebody $500, and that someone, which is a broker, guaranteed the price of each unit of natural gas at $5. Now, if natural gas goes up in price, right, the value of this $500 goes up. Why? Because your contract is worth more. Okay, but the opposite is true. If the contract went down, if the value went down, your contract will go down because you locked yourself at $5 and now the price is $4. Derivatives include swaps, options, forward contract, and future contract. Regardless, derivatives instruments are to be reported at fair value. So whatever derivative instrument we have, it gets reported at fair value. Now, this is a topic in intermediate accounting. And frankly, if you want to learn about this topic, you can go to my intermediate accounting channel, Accounting for Investment playlist, and I have, this is the first 10. I have another 10 lectures, and the next 10 will involve derivatives such as a forward contract, swaps, options, so on and so forth. Just want to let you know that it's there if you're available. But we have to differentiate between two types of derivatives because in the book they mention them, so I have to mention them. One is called hedging, and the other one is called investing, but it's really called speculative. But let's talk about hedging real quick. Again, this will be real quick. What is a hedging? When you buy a derivatives instrument for the purpose of hedging. What is hedging? Hedging is protecting yourself. Government enter into the derivative contract to mitigate the risk of economic loss arising from the changes in the underlying asset or obligation. Just like the natural gas, as I just told you. They want to make sure that they're only willing to pay $5. Let's go into a contract that will guarantee that price. So this activity is called hedging. So sometimes you buy a derivative instrument for the purpose of hedging. Another example will be foreign currency hedging. For example, a government purchase equipment from Germany and enter into a forward currency contract to protect against an affordable change in exchange rate. Let's assume the government purchased a piece of equipment from Germany and the German wants euros. So they want the euros, they'll give you 30 days. So today, each dollar will buy you, let's assume, $1.25. So let's assume that's the case, okay? Let's assume you paid, they want you to pay 10,000 euros. So you need to pay 10,000 euro, but not today, 30 days from now, okay? To buy the 10,000 euros today, okay, let's see how much would it cost you to buy the 10,000 euros. I should have made $1 for $1. It will be easier, but that's fine. My calculator isn't working. Okay, you need today $8,000. So if you take 10,000 euros divided by 1.25, you need today $8,000, and you'll be able to buy the 10,000 euros. But you don't have to pay now. So you need 8,000 US dollar. You're not paying now. You have 30 days to pay. What is the risk? What is the risk here? The risk is 30 days from now, maybe each dollar will buy you only $1.15 of euros. You might be thinking, well, that's good, it's going down. Actually, the euro is going up. What does that mean? If you wait and you need 10,000 euros, you divide this by 1.15. So you take 10,000 euros divided by 1.15. Now you need to pay $8,695 US dollars. So what happened is, because you waited, now you have to pay $695 more because you waited 30 days. So what you would do, you would enter into a contract guaranteeing the price of $1.25. Now again, the price could go down to 115 or it could go up to 130, which you will benefit if that's the case. You need less US dollar to buy the euros, but the government doesn't want to take those chances. They want to guarantee their price. So this is what a derivative instrument is. And government should stay away from derivatives instrument. Hedging maybe, but not for the next thing we're going to look at is investing. But this is basically what hedging is. Okay? If the derivative is effective in reducing the government exposure, and we're going to assume it's effective, then the changes in the value of the derivatives are deferred. So the value are deferred. So this is what it means. It means the changes in the value are reported in the statement of net position. So simply put, you report the changes on the balance sheet, not the activity statement. So you don't show the changes. Because why? Because you are not trying to make a profit. All what you're doing, trying to protect your risk because you have a payment in euro. The deferred gain or loss typically continue to be reported as deferred inflow if it's a gain or deferred outflow if it's a loss. So basically what you do, simply put, if the derivatives instrument is for hedging activity to mitigate your risk, then you report any changes in the statement of net position as either deferred inflow or deferred outflow. Now, if your investment in the derivatives is for speculative purposes, what's speculative? Basically, you're gambling. You buy the euros, you're hoping that the euro will go up or you're hoping that the euro will go down. You have no business of buying the euro except for speculative purposes. This is less commonly with the government, but if that's the case, if the government wants to earn a return, then any gains or losses, those are reported basically in the quasi-income statement, okay? So they're reported in the period that of the value change. So they are reported in the statement of activity. Okay, that's all what you need to know about derivatives as far as we're concerned. So let's go ahead and start an example. Again, if you want to learn about derivatives, by all means, I have like maybe 6-7 lectures in my in my intermediate accounting, where you'll have a full-blown lessons about this. So let's take a look at a private purpose trust accounting. So the first thing, to have a private purpose trust, someone will have to contribute money. Usually it's a wealthy individual. So let's go ahead and get started. Assume on January 1st, a wealthy individual contributed $500,000 to the village of Riverside and signed a trust agreement specifying that the principal to be held intact and invested. So they don't want the principal to be spent. They want the principal to be intact. Only the earnings to be invested. So the income to be used to provide college scholarship to selected graduates. So notice here, selected, it means it's for a specific group. Okay, from the villages to high school. That's fine. Maybe it's for who knows, selected students for a specific income level. Who knows? Okay. On January 2nd, the gift was recorded in a newly created scholarship fund. So let's go ahead now and establish the fund. We're going to debit cash. We have $500,000 in that fund, and we credit addition contribution of $500,000. Think of this as like income to the fund. Addition is like basically income to the fund. Now guess what? What are we going to do with this what are we going to do with this $500,000 cash? Well, we don't keep it. We need to invest it. So what we're going to do next, we're going to invest the contribution. On the same day, the village administrator purchased a bond as an investment in the amount of $480,000 plus interest, plus accrued interest. So the bond had some interest accrued, therefore we bought the bond and we purchased the interest. So the bond carried an annual rate of 6% payable semi-annually on May 1st and November 1st. So we bought it when? We bought the bond at the beginning of the year. So we bought the bond at the beginning of the year, but it accrued some interest, remember, because the last time it paid interest was November. So it accrued interest for full November, okay, and full December. That's why we have 2 months worth of interest, okay, which is worth $4,800. Therefore, we debit investment in bond. The bond, we bought it for $480,000 plus the accrued interest. The accrued interest is $4,800. And if you want to double check yourself, if you take it's a $480,000 bond times 6% times 212, the 2 month worth of interest. Let me just double check the math, make sure that this is correct. 212 times 0.06 times 480,000. It is 4,800. So this is how we came up with the 4,800, because the bond paid interest last on November 1st. Therefore, whoever we bought it from, we have to pay them any accrued interest that they carried from that date. Therefore, we paid 484,000. Well, they gave us 500,000. We haven't spent the whole thing. We still have $16,000 in cash, but this is what we have now. Now, guess what? Why did we have the money? To pay scholarship. On May 1st, scholarship fund received interest in the amount. Actually, first we received interest. Okay, good. So first we received interest. We received interest in the amount of $14,400, of which $4,800 was accrued at the time of the purchase. So first we received the interest. So let me go ahead and do the receive the interest first, because that's what we did first. So we receive in the amount of $14,400. So what do? We're going to debit cash for that amount because we received the cash of $14,500. So let's go ahead and debit cash $14,500. Okay, debit cash $14,500. Remember, we had interest receivable of $4,800. We're going to credit interest receivable $4,800, and the difference is $9,600, and that's interest revenue. So this is interest receivable, and the second one is interest revenue, $9,600. Well, basically interest revenue or addition, which is called, addition investment earnings. Okay, so this is the entry that we make. Then we also deduction scholarship award. Then we paid $9,000 for scholarship awards. Therefore, we call it deduction. We don't call it an expense. We call it deduction. 9,000 credit cash 9,000. So basically, we just earned 14,400 in interest. I showed you the entry: debit cash, credit interest, accrual, accrued interest. Then credit the interest income. Then we disperse $9,000. Credit cash, debit, deduction. Again, deduction is like an expense, but we don't call it an expense. Earning interest income on May 1st, the fund received on November 1st now, the fund received interest in the amount of 14,400. Now, where is the 14,400 coming from? If you look at the principal, 480,000 times 6% times 1/2. Why 1/2? Because the bond pays interest semi-annually. Last time we were paid interest was May. Now we are getting an interest in November. So if we take, once again, 480,000, the bond is paying 6%, and multiply this by 0.5, which is 6 divided by 12, will give us 14,400. So we're going to debit cash, 14,400, credit, obviously, investment earning, or just basically interest income of 14,400. Then from November till the end of the year, remember last time we got interest in November. Now from November, we're going to have 2 months of accrued interest. So we're going to accrue 2 months of interest, 480,000 times 6% times 212, debit interest receivable, credit investment and earning 4,800. Okay, so we accrued the interest. And remember, because we have an investment, GAAP requires us that the investments be reported at fair market value. Remember that investment and bond, we have to report it at fair value. So this is a fair value entry, not accrued interest. Assume that the bond has a fair value of 482. So remember, we bought it at 480. The bond went up to 482. So the bond went up by $2,000. So what's going to happen, we're going to add it to the bond, investment and bond goes up, and we're going to credit addition investment earning net increase and fair value investment of 2,000. So notice this is basically in addition, like revenue, although it's unrealized. This is an example of holding. This is an example of a holding or unrealized gain. This is an example of that. Okay, in case you're wondering what is holding an unrealized gain, that's what it is. So the bond went up in value, but we did not sell it. It's not realized. At the end of the period, we close all the accounts, the temporary accounts, which are the addition, the contribution, investment earning interest, investment and earning the net increase in value, close the deduction. We only paid 9,000, and close everything to fiduciary net position, the account called fiduciary net position. Now let's take a look at the financial statement and forget about this one for now. This is for retirement fund, which we'll cover later. We have cash of 35,000, accrued interest receivable for 4,800. The investment is reported at fair value, 482. So those are your total assets. You don't have any liabilities. Then you have net position restricted for scholarship, 521,800. Okay, so this is what the statement of fiduciary net position, we don't call it balance sheet, fiduciary net position. And this is the statement of changes in fiduciary net position, like basically in a sense like an income statement. Don't worry about the public employee retirement fund, we'll look at that later. We have contribution of $500,000. We earned interest of 28,800. Net fair value in the investment 2,000. Notice realized and unrealized, everything is reported all together. So total addition 530,800. We only paid 9,000 out for scholarship. So the net increase in fiduciary net position 581. The beginning position was 0. The ending position 521,800, which goes also here 521,800. So this is basically hopefully a good example of how to account for this type of trust. If you have any questions, any comments, by all means email me or see me in class. Again, if you're studying for your CPA exam, study hard, it's worth it. And remember, the private purpose trust fund is different than the permanent fund. A little bit similar, but it's still different. Good luck.